This is The Real Story with Michelle Makori.
Hello, thank you for joining us. I'm Michelle Makori, and you're watching The Real Story, where we go beyond the headlines, beneath the surface, and behind the curtain to uncover what is really happening with money, markets, and power. And markets just keep climbing. Stocks are surging to record territory, the S&P and the Nasdaq all pushing to new levels. But the U.S. economy is flashing mixed signals. The soft landing story is starting to look quite shaky. Headline CPI is still running hot at 2.9%, and we're seeing major cracks in the job market. We just had a massive revision from the Bureau of Labor Statistics, which erased about 911,000 jobs from the past year. So that shows that the job market was not as strong as it looked, and that the slowdown started earlier than many thought. Of course, all eyes are now on the Fed. Markets are betting on cuts now at every remaining meeting this year. But keep in mind, rate cuts usually come after the damage, not before it. And history reminds us that those cuts usually confirm recessions, not prevent them. And that often leads to market bottoms. And there is a big market signal that my next guest has flagged and that he says is a big warning sign. Insider sales. Corporate executives have been unloading stocks. The CEOs and CFOs with the clearest view of what's going on are selling stock at the fastest pace in years. So here to help us make sense of it all, to give us his take on the markets, on the Fed, on gold, silver, copper, Bitcoin, and more, is Gareth Soloway. Gareth is the chief market strategist at Verified Investing. He has over 2 decades of experience as a trader and a technical analyst, and he's known for his bold and timely calls, like predicting in late 2021 that Bitcoin, then at 69,000, would fall to 20,000 in 2022. And he also correctly forecast gold's breakout when it was stuck around 1900 in 2023, saying that it would reach 3,000 by late 2024, early 2025. Now, Gareth combines technical chart analysis with macro fundamentals to cut through the noise and tell investors where the opportunities and the risks really are. Gareth, so good to have you. Welcome.
Thank you so much, Michelle. It is so wonderful to be here. Thank you.
All right. Well, Gareth, as I just mentioned there, you have had some remarkably correct calls on gold and Bitcoin. Those are just 2 examples. And what I appreciate about you is you always give specifics and timelines. You never shy away from that. But before we get to those details, I want to start off with your overview, your big picture. And Gareth, as we mentioned, markets are at record highs. But what is really the story of these markets right now? What do you see on the charts that the mainstream narrative is missing?
Yeah, so there's a bunch of issues out there that are emerging, and part of that is in the economic data, right? I mean, you just mentioned before 911,000 jobs revised downwards, and that's a massive number. I believe the biggest number we've ever had. I can't help but chuckle at the fact that it was 911, so like dial 911 for the economy. Then we saw jobless claims this week that jumped sharply. Now, granted, 1 week of jobless claims doesn't necessarily make a trend, but it's starting to show us that there is a contracting labor market, and that's a concern. And then you put in the charts, and the charts are where things get even more interesting, where past cycles, when they've topped, we're seeing the exact same things. We're seeing irrational exuberance from investors where they're willing to buy these kind of pump and dump stocks. We're seeing big names like Oracle going up 40+%, biggest move on a large cap that has ever occurred. And these, again, historically are major signals of irrational exuberance. And so, again, I do want to go into some of these charts because they do absolutely give us a clue into what the markets are doing. So let's start with the S&P 500. Here's the S&P 500. This is what's called a wedge pattern. Now, upsloping wedge patterns, as they get tighter, it contracts and kind of makes a pressure cooker of the market. In other words, it's putting the market tighter and tighter, ready to explode in one direction. I base my analysis off probability. And when you see this type of pattern, this is a pattern that is basically winding a spring ready to break in one direction. This pattern formation has a 70% chance of breaking to the downside. If that happens, it's not just going to be a small move, it's going to be a major move to the downside. So again, this is just the S&P, you mentioned the insider buying and selling. That is an unbelievable, scary chart, and it has gone on for months. The fact that we have been seeing more and more of insiders just dumping, and we're talking Jeff Bezos, billions of dollars. Now, you could say he just wants to buy another yacht. Okay, that's fine. But what about other insiders, right? So let's take a look at what we have here.
He has an expensive fiance there, Gareth. That
He
wife
does.
now that he's got a fund. But no, you were the one that signaled to me, look out for these insider trades, because you said this is a huge sign that we're late in the cycle. So yeah, break that data down for us.
Yeah, so this data shows us, and this is just the last 30 days, but if you were to look at the last 6 months, it almost looks identical. And the green obviously represents the buying, the insider buying. And remember, when it's an insider, it's basically a CEO, CFO, CTO, COO. I mean, these are people with intricate knowledge on their business. And if they are dumping like this, number one, why are the markets still going up? Because you have retail FOMOing into this market, but it tells you their viewpoint on where they think their stock is valued at. And they obviously wouldn't be selling if they thought their stocks were undervalued. I mean, that's just common sense. And so, I'm all about breadcrumbs, right? You want to take each little breadcrumb and put it together. And once you start getting a mountain of breadcrumbs, you have to start paying attention. And there's so many of these signals out there that just continue to ramp up.
Okay, we'll get into more of those signals, but I do want to get more into this insider action. We mentioned Jeff Bezos of Amazon. Who else? Who else has been a big seller now?
Yeah, I mean, you've seen Benioff sell with Salesforce. He's been unloading now for quite some time. Zuckerberg has been unloading. And obviously, those are the names we all know. But needless to say, it's not just those. I mean, you look at other major players out there. I mean, even Jensen Huang is unloading some of his position. Now, you could say, again, some of these guys just want to take some money out and kind of pocket it, if you will. And no one can blame them for that. But again, when you see it this lopsided, right? That chart we just looked at was massive red almost every single day, and you can barely see the green, and that was just the last 30 days. Imagine that chart going back 6 months of that every single month. There's a trend there, and these insiders they know exactly what they're doing. Let's be fair.
So, Gareth, you mentioned Jensen Huang, that is the CEO of NVIDIA. For those not familiar, he's sold roughly, I believe, $35.5 million worth of stock in a few transactions. But pull up that insider chart again, because I want you to really explain what those bar charts in the red mean. What does that actually mean? Where does that data come from?
Yeah, so this data comes, so every time an insider unloads, sells, or buys, they have to report it, right? Because they're an insider, they have to be tracked to make sure they aren't doing something illegal, right? So for instance, there's a quiet period just before a company reports earnings where insiders are not allowed to unload their stock. They can't buy or sell because the idea is they know what their earnings are going to be. And so 30 days prior, they can't do it. But once that passes, they can do anything they want. They can buy, they can sell. And what we're seeing is just massive amounts of selling. And so each candle represents literally hundreds of millions of dollars potentially. I mean, here you're talking about this one over here is over $3 billion in insider selling on this one particular day, which looks like the 10th of September. So just literally a couple days ago, there was over 300, actually it looks like $4 billion worth of insider selling. And then you just basically, when I look at this, and to be fair, I don't necessarily care how much on each individual day. I look at it like a bigger picture. Like if you just step back and look at the combination of green versus red. Now, if this was an average market, we should see a combination equal, about the same amount of green and the same amount of red. But instead, this is like 50 times the amount of red or insider selling than there is insider buying. And again, investors really need to pay attention, right? I mean, think about it from any of our perspectives. If you're the CEO of a company and you believe in your company and you believe that your stock is going to go higher and you believe it's underpriced, why would you be dumping this amount? Now, listen, everyone knows insiders will sell a little bit here and there. They want to buy a new yacht, whatever it may be. But this magnitude is alarm bells galore.
Mm-hmm. Do we know what they're using those proceeds to buy? Do we have any indication of that?
I don't think we actually know. I mean, again, we may hear Jeff Bezos has a new yacht, right? Like that's the common one.
Well, where they're parking their cash, where are they putting the proceeds? Do we have any data that could point us in that direction?
I think the only data we would have in that scenario, if they end up owning a substantial amount of a publicly traded company, then it has to be reported like 10%. But anything less than that, they don't. But my guess is this is going into more conservative T-bill type scenarios that will just spit off an income. It gets them out of the risk. They know the market metrics, right? I mean, again, while markets continue to make new all-time highs almost on a daily basis, they are fully aware of valuations. They know the hype that's in the AI trade right now. They can see, and a lot of these CEOs are as old as me or older. They remember 1999 and 2000. I vividly remember that. And the insanity there is almost identical to what we're seeing now.
Yeah, that irrational exuberance, as you said. And it's the retail investors that are not getting the signal right now. In fact, the markets have been rallying on expectations of a Fed rate cut, the first one since December of 2024. We've discussed this. The Fed is effectively stuck between a rock and a hard place. Inflation well above that 2% target. We're starting to see dramatic signs of weakness in the labor market with that huge revision. I like that you said 911, that in itself is a sign of emergency there.
By the way, even spookier, that 911, obviously dial 911, but it came out 2 days before 9/11, which is even, again, I'm not a conspiracy huge person like that, but these type of things, it's just so weird. It is so weird.
Well, I know you look for patterns, right? And that's the whole point of technical analysis there, but you also, of course, combine it with macro and fundamentals. But as we said, this is the data that the Fed is basing its decisions on, right? So how is it that this data is coming in so incorrectly? Like, what is happening that there is this huge miss by 911,000 jobs? Oops, we miscounted. Like, what is happening in the process? Is it by design? Is it a procedural issue? What's your best guess as to what's going on there?
Yeah, so and that's such a big topic right now. Is it done deliberately or is it just an oversight? And I think we have to go to the root of the problem. And again, I'm not saying that there's nothing done deliberately out there, because there certainly is, but one of the things that drives me nuts is that the government sends out these surveys to companies and they say, hey, could you please let us know, are you hiring, are you firing, are you doing nothing? And there's a tendency, if a company is hiring, they're quickly like, oh yes, this is good news, let me fill it out that we're hiring and send it back in. But if they're not, if they're firing, no one wants to write that in. Like, yeah, I had to fire 5 employees today or whatever it may be. And so because the government doesn't make it mandatory that there's a receipt of this data back to them by a certain date, there tends to be a lag on receiving this data, right? It's kind of like goes on the pile and the CEO says, oh, I'll do it when I have time. It's not great news. And I think that's one of the big problems. And it drives me nuts. If you and I get something from the IRS, they say respond by this date. And we all know, if not, you're in trouble. With this type of stuff, there's no penalty. So like a company can just take their merry old time, yet the Fed is literally basing their decisions on federal interest rates on this data, right? We're all trading. Like, as a trader, I am trading on this data. It needs to be accurate. The government needs to put a direct receipt date on it, like get this information back by X date, or there will be a fine. And I know that sounds crazy and kind of maybe a little ruthless, but when you have trillions of dollars being traded on this information, you have to have it accurate.
Couldn't agree with you more. Clearly, there needs to be some serious revisions made to this data collecting process as a starting point. Okay, so nonetheless, we have the Fed now getting this data. What are we expecting? We're expecting a rate cut. What is the rate cutting cycle that you're forecasting?
Yeah, so I'm going with what the Fed Watch tool is saying right now. I think 3 rate cuts into year end, 1 at every meeting. I know after the last jobless claims shot up sizably to 263,000, which was dramatically higher than anyone expected, the markets kind of rallied on hopes of a 50 basis point. But this is the tricky thing. We are now in an official stagflation environment. And really, most media is not going to announce that, folks. But the definition is slower growth. And in this case, the labor market is slowing dramatically, and higher inflation. And we saw the CPI this week coming in at 0.4% on the headline. And just map that out, multiply it by 12. If that stays at 0.4 every month, we are basically at 4% inflation, if not even a little bit higher. And so that's the definition of stagflation, and that puts the Fed in a ridiculous bind. So yes, they will give you a rate cut. coming next week, 25 basis points, probably one at every meeting. But the markets, in my opinion, have already priced that in. And my thing is this: I think we sell off next week. And by the way, late in the day on Friday, we saw some big accumulation in the VIX. The VIX is the fear index. It's basically below, or was below, 15, very historically low. And when I see that, it is a warning sign that institutions are starting to buy protection for expected volatility. And so ultimately, my expectation is a very hawkish Jerome Powell. Yes, he'll do the cut, but he's going to talk about how inflation is still an issue, and it's going to make the market rethink how many cuts next year they're going to get.
Well, you know, Gareth, historically, as I mentioned, Fed cut rates just before some of the biggest crashes, some of the biggest market bottoms, and I believe you have the data to show that.
Yeah, I don't have a chart on that, but folks, I have seen these charts every which way, and we can definitely put one in for you. But the key is this, is that if you look historically, markets rally on rate cut expectations, the excitement of cheap money. But once the Fed starts cutting rates, historically, the markets actually go down. And the reason they go down is very simple. By the time the Fed actually starts to cut, the market is fretting that they are behind the curve once again, like the Fed usually is, and they need to cut more. But the Fed is very slow on cutting, and we're seeing that with the inflation numbers. The Fed will likely just cut one time at every meeting into year end. And so the market then starts to price in that things are a lot worse than expected and that we're heading towards a recession. A recession means lower profits and profit growth for companies, and PE ratios start to adjust. So be ready for that in this scenario. And remember, technicians like myself, we don't reinvent the wheel. We look at historically what happens every time, and if it happens every time, who are we to think this time will be different? A lot of investors out there will tell you, oh, this time's different. I heard that in 1999 too, and then we saw 85% drops in many of the big name tech stocks then as well.
So putting all the crumbs together, collecting the data, collecting the signals, what is your forecast? Like, what are you seeing happening?
Yeah, so I think the markets will start to see a top being put in here over the next week or weeks. I think it's going to be a choppy period because, again, we've lured investors into believing that every dip, even 1, 2, 3% dips, are buying opportunities. But as that gets dissipated, as the investor starts to run out of investable income, that will then start to slide further and further south to the point where I do think you're looking at a 20-30% correction into next year once again. And the difference here is everyone will expect it to rebound like after the Liberation Day sell-off, after the COVID sell-off, after even last in 2024, that August nasty sell-off. We came back to all-time highs. I don't believe that is going to happen. And I think, honestly, the market and maybe Fed officials and maybe government officials have done a big disservice to investors by luring them in. Since COVID, millions of new young investors have come into the market, and they now believe that the biggest correction they'll see, yeah, they might see down 20-30%, but within 3 months, we're at all-time highs. That is not always the way. In fact, if you look back at 2000, when the NASDAQ collapsed, 15 years it took for it to hit a new all-time high.
So, but you're saying a 20 to 30% pullback in equities by the end of 2025?
No, I don't necessarily know if we'll be down that much in the next 3 months. I think it's early 2026. And the kicker is this, is that, again, because the markets trade on psychology, right? So you have the human psychology of, oh, it's a 3% pullback, let's buy the dip. Okay, so then you get a 2% bounce, right? Then you get a 5% pullback, buy the dip, you get a 3% bounce. And so initially when markets top, they tend to top with a lot of chop with a slight downward angle. And then eventually people start to say, wait a minute, I keep buying the dip, and then it keeps making lower lows. And then they stop buying the dip, which is when the downside accelerates. And that's usually the bigger move. So initially, especially the way the markets have been conditioned, you'll see sideways to slightly lower chop. Then the downside comes in probably in early 2026.
Right. So where are we in the fear and greed cycle right now? Because I know that is something you look at closely.
Yeah, and we are in extreme greed to the point where, I
Still.
mean, when you see Oracle, and I'm going to show you guys a few charts here that just kind of blow my mind here. So let's look at Oracle, ORCL. 40% actually was up as much as 40% on earnings. This company was valued at $700 billion before earnings were before it basically plummeted back down here. But when you see these type of moves where a company can gain that much, and again, by the way, you have to go back to the 90s, by the way, pre.com, the last time Oracle had a move of this magnitude. And that's very telling to me is when you start to repeat history, it makes me on high alert. But we see that Oracle's obviously coming back in. But then you have other stocks like QMMM. This stock in one day ran 2,700%. Now, all this company did was say, hey, we're going to put some crypto in our treasury, and investors rallied it 2,700% in one day. And again, you could go to many other names. Octo was another one this week. Octo rallied 5,600% in one day. And again, for those of you that have traded crypto, remember in 2020, 2021, or even prior to that, where altcoins were doing this type of massive move, and then the collapse occurred. And this to me is a sign of that kind of gambler's mentality that is so concerning in our markets right now. And again, just a couple other charts that I'd love to show you guys here, because I do think this brings a kind of a more grounding perspective. And one of the things I talk to everyone about is just look for the breadcrumbs. And the breadcrumbs, while it doesn't tell you like on this specific date the markets will top, it gives you enough data to make smart decisions, right? And you might feel like, oh, I missed the run up or I missed, the last leg. But you know what? Protecting, at least for me, protecting my money is the most important thing. This is the S&P price to sales ratio. We are now at a over 3 standard or over 2 standard deviations away from the average, historical average. And by the way, we are more than in 2020, and that is astounding. Then we flip over to this chart. Here's the S&P 10-year PE ratio. 2 standard deviations above. Granted, not at the internet bubble high, but incredible how overbought we are in that metric. And then lastly, this one, guys, this is the Buffett indicator, right? So we all have heard about Warren Buffett. Buffett indicator is the ratio of total value of the U.S. stock market versus the current measure of total GDP. And look, we are now at all-time highs on this metrics. You can go back to the dot-com level. We're above that. You can go back to the 1970s. We are above that as well, right up there. And basically, I mean, just to summarize, when you're 2 standard deviations above something, it doesn't tell you, again, this date, we're going to reverse this second. What it tells you is you better be freaking on point, because at some point the music is going to stop and the rug is going to get pulled. And the higher you get, usually the harder you fall.
All right. Well, Gareth, we've also got some commodities giving us signals that corroborate the slowdown in the economy. Copper, traditionally a barometer of the health of the economy. What is Dr. Copper telling us?
Yes, copper is definitely something that is getting my attention. This is just one more of the many charts that has my eye here. Now, normally, and listen, we're starting to see this labor market weaken, so it's starting to make more sense. But prior to these latest jobs data points and these revisions, everyone was saying soft landing, the economy is going to be fine, the Fed will cut, it'll re-energize. But look at this. Copper right now is trading at levels it was trading back basically a couple years ago. And this formation here in technical analysis is known as a bear flag. All right, a bear flag is a sharp drop where then digestion occurs. And in general, when this pattern forms, you get an additional move to the downside. And listen, copper, if the economy and the global picture was going to improve, copper would not be going down, or likely the chart would not be telling us it is going down. And the same thing for oil, by the way. If we flip over to oil, oil is in a treacherous scenario here where we are trading now at levels, basically you're going back to 2021, kind of in that range of where we were trading just before the COVID collapse. And again, if the economy and the global picture was looking amazing, you would not be seeing oil trading down here. And by the way, I'm looking at oil. We are now, and again, I'm going to get rid of these 2 trend lines. I want to show you this. You're essentially coming into a major support level around $58 per barrel. If that breaks, you're likely headed to $43 a barrel. In fact, that's my 2026 downside target on oil is $43 a barrel. And you're not going to be at $43 a barrel unless we're in a recession. Put it to you that way. So again, that does tell us that there is some major weakness here.
All right, recession, technical recession as in 2 quarters of negative GDP growth is what you're calling for. Well, a stagflation, higher inflation and slower growth.
Yeah, and again, I think what's so important is that you have this kind of divergence within the U.S. population already. You have people that are well invested and they are still feeling very wealthy, and they are continuing to drive and keep the economy afloat. And then you have everyone else who doesn't have a lot of investments, who is getting crushed by inflation, who's getting crushed by housing prices and all of these other things, and they are already in a recession. In fact, you could argue they've been in a recession for a long period of time. So the only thing keeping this market or the economy afloat at this point is the stock market. And the question is, how long can the stock market keep going up? If it goes up forever, okay, we're set. We're good. We won't have a recession. But if you get a correction here, you will see that recession, and the stock market will be the culprit.
Well, but let's unpack that, because you have been a perma-bear, some would call you, sort of negative for a while because the fundamentals
Correct.
Justify that. And yet the markets keep grinding higher, yet the can gets kicked down the road continuously, and there's still this turnover. So why would that be different? Like, what would happen to change that?
Yeah, and you're absolutely right. Like literally for the last year or so, I've been generally very cautious. Now, I still, when we had the Liberation Day sell-off, I was still buying at that point. But then once we gained back 10, 15%, I said, you know what? I'm going to take my money off the table, and I slowly have started to inch in on the short side of this market. There's no doubt about it. I'll tell you a story. So back in 2007, early 2007, I had some money that I was managing for some family members, and I wrote them an email and I said, guys, I'm really uncomfortable about what I'm seeing in the data here, in the markets and everything beyond. Things are not going to last. I think you guys should be very cautious here in your investments, right? And some paid attention, some laughed at me, and they said, no way. And literally it took a year. I was a year early before the collapse occurred. And in this scenario, in general, that's the hardest thing. You see the writing on the wall. The breadcrumbs lead you to that, but it ultimately takes longer. And it takes longer partially because the Fed is already starting to make money easier to get. Let's lower rates, more money in the system. The government has been spending hand over fist like a drunken sailor. That's more stimulus in the system. There's so much in the M2 money supply that it keeps things afloat. But the writing, again, is on the wall, and I'd much rather, at least from my own portfolio, and I can only speak for my own portfolio, I would rather be cautious and miss 10% of upside or 15% of upside versus giving away half of my portfolio in a major market crash.
All right, well, Gareth, gold is sending some pretty strong signals as well that tend to corroborate your thesis. I want to point out to the audience that is not aware with you that you were very early and vocal on gold when people were completely dismissing it. As I mentioned earlier, in 2023, gold was stuck at around 1,900. You said it was heading to 3,000 by the end of 2024, early 2025. You were correct on that. People were calling you a ridiculous gold bug. So I like to point out that you were very on the money there. And had it as a couple of your strongest points of conviction during some of our interviews. So gold is up roughly 40% so far this year, breaking new record highs. Also an interesting fact for our viewers, by the way, that January 21, 1980, gold spiked to 850. So if you adjust that for inflation using the CPI, the standard yardsticks that the economists use for the Fed, 850 then is roughly 3,590 in today's dollars. So with spot now above that level, we're not talking about a normal record. This is real inflation-adjusted record levels for gold. I mean, that surpassed the Volcker era peak. So anyway, again, you can look at that. Different methods move that number a bit, but big picture, gold is now at an all-time high, inflation adjusted. You've had correct calls. Where do you see gold going now? What are the key levels you're watching? What are the key levels investors should be watching?
Yeah, so, and thank you for mentioning that. I still remember being called all the names in the book saying gold never moves, it's never going to do anything. And again, it was just following the chart. The chart had this beautiful cup and handle pattern. It was just one of the best technical pattern setups. But looking at gold now, if we go to the chart here, what we can clearly see is that gold has had this big breakout above 3,500, which is what you mentioned was the inflation adjusted all-time high. And I think that's amazing to think about, that the market doesn't necessarily, subconsciously it knows what that level was. And we went right there back in April, and then we went into this what's called long base of consolidation. And then what we've seen is a breakout above it. Now, there's two separate ways to look at this. In the short term, gold has put in what we call a topping tail, which means we should be due for a small pullback, which, by the way, small pullbacks are natural occurrences within markets. It's actually healthy for a chart to pull back, or a commodity in this case to pull back. So this topping tail signals that we'll probably retrace. What is the downside retrace where I would start buying again? At 3,500. Former resistance becomes technical support when you break out and retrace. And let's be clear, we're likely going quite a bit higher on gold from here. And the fact is it's just the basis of the government is going to continue to spend. The Fed is continue to do what they've loved doing for ages at this point, which is printing money essentially and flooding the system in any downturns. And that is going to fuel gold higher, and likely, in all fairness, probably down the line, Bitcoin as well.
Are you comfortable calling a bottom for gold? Do you see a very strong support line, 3,000 gold? What would that be if you're comfortable calling one?
And that's a great point. So 3,500 right now is the line in the sand that I'm watching, but there is always a chance when you've had something like gold run up as much as it has, you could go a little bit lower. But I will tell you this, there's a beautiful downsloping line and upsloping trend line here. It basically, at this point, I have a hard time believing gold would pull back lower than, let's say, 34 to 3,300. There's just way too much support now in this chart, in this zone, that as long as it holds there, you're buying it, at that pullback level. And that's exactly what I plan to do. So again, yes, in the near term, I'm a little like, again, if you say, well, where do you see gold in the next 2 weeks? I think gold comes down. I think it pulls back, natural occurrence. But if you ask me in 6 months, is gold higher? I do think gold is higher. Now, a lot of people are always asking, okay, well, what's your upside cycle target? Well, where could this go in the interim for upside? And I think to do that, what you do is you use what we like to do in the technical world, is you use essentially a parallel channel, right? And we start to look at parallels here. And I would say by end of this year, I would not be shocked to see 3,800. Now, that's not the cycle top, but I think 3,800 is likely your upside parallel trend line of resistance. So I think by year end, 3,800. And then I think you're talking in the next couple years well over 5,000.
Next couple of years. Goldman Sachs says that gold will hit 5,000 an ounce if money privately invested in the U.S. Treasury market shifted just 1% to gold. We've seen that trend with central banks around the world, where gold has now taken over U.S. Treasuries as the most held asset since 1996. So the Goldman Sachs saying that trend is likely to push gold to 5,000, also forecasting that by mid-2026, gold prices could reach 4,000 an ounce. Are you in line with that? Are you more bullish? You think Goldman Sachs has a right there?
I think Goldman is pretty much dead on at this point. I love what you mentioned about, these countries. Poland just announced again 30% of their treasury is going to be gold. I think the important thing is that we're slowly seeing this de-dollarization. And again, when people talk de-dollarization, especially in the crypto markets, they're like, oh, it's going to happen overnight. Reserve currencies, if you look historically, that never happens. It's a longer process, but we're seeing the writing on the wall. China just continues to buy gold. Poland now is going to do a portion. And essentially what they're telling you is that they don't feel comfortable with the power that the U.S. wields because they have to rely so much on the dollar. And so they're slowly diversifying away, which will slowly weaken the dollar over time. And in fact, the dollar chart is telling us exactly that. In fact, I want to go over this chart because the DXY chart is really, really telling. So if we go to the dollar chart here, what we've seen is a key breakdown in the US dollar here, and I'm going to just draw this in for you guys. So there was this trend line zone that was holding on the US dollar for the last basically 2 to 3 years. And you can see again, going back to 2022, we would hit, and every time we hit, we would bounce on the dollar. All of a sudden, we broke below. Now it becomes resistance. Remember, support, once support breaks, it becomes resistance. And now up it goes, rejected, up it goes, rejected. Now the concern I have here on the US dollar is if we flip to a longer time frame and we go back to 2008. And by the way, 2008 is not an arbitrary date. It is when the financial crisis started. And so if we take a trend line from there and we drag it up, the dollar has a very distinctive trend line that basically goes from 2008 all the way to the current lows. My point being, if the dollar breaks this level around 96 to 95, that would be a major technical chart breakdown. And I would say, listen, again, I want to be clear. It doesn't mean it's going to collapse overnight, but I would actually think the dollar would head within the next, let's say, 5 years down to 70 on the DXY. And 70, I mean, that would be shocking to see for all of us.
And again, for our viewers, DXY, a basket of other currencies that the dollar is weighted against. And, Gareth, part of the reason that we're seeing gold go higher is because it's priced in dollars. So as we're seeing dollar drop, gold goes higher. Many would argue that that is by design, that the Trump administration wants a weaker dollar to promote the idea of onshoring, bringing manufacturing back into the U.S., making the U.S. independent, making it a sovereign nation, not dependent on other countries. That's a bigger sort of macro conversation. But I'll use that as a jumping point to ask you how much macro influences, your views when you're putting together these charts, and what macro signal would tell you that gold is about to break much higher?
Yeah, so I think the big macro signal is this, right? Is you have two scenarios. So number one, the stock market and gold have been making new all-time highs consistently together. That does not last. If you look historically, it can last for short periods of time, but it's telling you one of them is not going to last. And in this case, I believe gold, while it might have small pullbacks, gold is going to be the one that is going to outlast, whether it's weakness in the dollar, whether it's the labor market and people running for the safety, whether it's global central banks that continue to buy gold, or these countries that are going to continue to buy gold. Gold is becoming that place to go, along with Bitcoin to a much lesser extent, where money is flowing. And again, if that's going in that direction, that's not good for the stock market overall. So that's a big one that I'm following. And again, keep this in mind. Watch for a break of trend from either gold or the gold or the market. And I do think the stock market will give way as the data continues to weaken here.
Let's talk about your bear case scenario. If you had to give me your bear case scenario for gold, as well as your bull case scenario, I think you've sort of given to us, but you can elaborate on that. Your best bull case and your best bear case here for gold.
Yeah, so as a technician of the charts, you always want to look at both sides of a trade, right? Because you can believe you're going to be right in one direction, but if it goes against you, how do you maneuver? And so the bear case on gold is probably a retrace to 3,000. 3,000 would be unbelievably important for it to hold. It's that key psychological number. You don't want to see, if you're a gold bug, if you love gold, if you're invested in gold, you don't want to see a two handle at the beginning of gold. So 3,000 right now, again, that 3,400 is where I'm thinking it'll pull back. If it breaks that, you could see 3,000. That must hold. And I do believe that, again, for me, anything below 3,500, I'm going to start buying gold actively all the way down to 3,000. If it breaks 3,000, I'm going to get a little bit concerned, though. Let's be fair.
And most aggressive bull case?
Most aggressive bull case is probably, you're looking at like 10,000 on gold. I would say that would be a dream come true for me that holds a fair amount of the metal as a long-term investment. And I do think, again, if you look at the scenario where we're now as a country spending $1 trillion just on financing the debt, the interest on the debt, I mean, this is really setting up for what I fear is the 100-year cycle, which would match up with the Great Depression. And again, by no means do I want to scare people by using that term, and it's not on the horizon. But I do think they always say, and this is something I grew up with. My grandmother went through the Great Depression. She taught me a lot. But every generation is supposed to experience something like that. And we've gotten away from it. People think it's just easy times and money can grow on trees, essentially, and the Fed can always save the day. and there's something called a 100-year cycle, and we're just nearing that 1929, 1930 period that would be that 100-year cycle for the Great Depression. And I think gold would be the main avenue, and Bitcoin to some extent.
We'll get into Bitcoin, but yeah, 100-year cycle, a fourth turning, whatever you want to call it. It's something that Ray Dalio has also been talking about very recently. He, of course, is the founder and former CEO of Bridgewater Associates, and Dalio is recommending that investors allocate 10 to 15% of their portfolios to gold right now. He's warning, much to your point, that the U.S. cannot service its debts, that it spends so much more on servicing the debt than the defense budget. And in his words, this squeezes out other spending, builds up as plaque would in a clogged human circulatory system. He says that the economy is basically headed for a heart attack. So what kind of allocation do you think makes sense? And I understand portfolios are personal, but is a 10 to 15% allocation reasonable? How would you rate that?
Yeah, I think that's very reasonable. And again, when you have equities that are priced at levels where, you can see these mega caps correct 50%. And let's be clear, in 2021, the bull market of 2021, Tesla was the stock, right? I mean, that was the crazy stock that everyone loved. That corrected 75% from peak to trough in the bear market in 2022. And so if you go back to Oracle, for instance, we were talking about Oracle. In 2000, Oracle fell 85%. And so, you look at assets that, it's not to say gold can't go down, but it's very unlikely you're going to lose that type of money. And you really want to be more of a protection player for your portfolio. So I think 10 to 15% makes a lot of sense on gold. I'm actually a big fan of diversifying, not just with gold, but platinum and palladium, silver to some extent as well. But what I love about platinum and palladium is that as you look at the rarity, right? So for me as a technician, I always look at the data, and we know platinum and palladium are like 30 times rarer than gold. It's just gold is the one that everyone loves because it's what jewelry is made out of. But when you start looking at fiat currencies and what's going on with the printing ad nauseum of these currencies, you got to start saying, well, platinum and palladium haven't even caught up to where gold has run. Maybe that's the hidden trade here to go long. And granted, I understand with cars and the demand, I mean, a lot of why platinum moves the way it does is because of the metal that is used in cars. But also, you just have to say it is so rare, it's even rarer than gold. Maybe that's the secret place to stash a little bit of cash. And that's what I'm doing as well. I'm picking up a little bit of platinum and palladium here over the next couple months because they are way discounted to gold.
But platinum still has had quite an astronomical run, I believe, up 40% for the year. But I'm going to push back on that. It may be rarer, but it's not what the central banks are buying. And part of the narrative for gold is that it is potentially being positioned as a neutral reserve asset as we see this de-dollarization trend. So platinum may be rarer, but you may want the commodity that there's more consensus around.
And you're 100% right. And by no means am I saying don't have gold. I mean, gold should be the core holding. But I do think people buy Apple and Microsoft stock, and those are like your blue chips. Well, gold is your blue chip metal. But I do think there's portions of a portfolio where you could say, okay, well, 2% to platinum, 2% to palladium. And if those run up, let's say 100, 200%, but gold only goes up 25, you're really getting a little bit more bang for your buck in that scenario.
When you're looking at gold, are you looking at physical gold, ETFs, the miners? How are you suggesting that people allocate to gold?
Yeah, so I mean, in general, I'm a big fan of the physical, just because I wouldn't call myself a prepper, right? But I'm someone who says
I would call you a prepper.
Okay, fair enough. But you want to have something that you have in your hand. If when I buy gold and I buy some physical gold, and listen, I have my investments in my swing trade accounts in GLD and GDX and all these other places, but you always want to have a little of the physical, because if all of a sudden you wake up one day and the credit cards aren't working and you can't go to the bank to get money out, you need some sort of currency that has value. And I think it's just important as an investor, I look at risk. And while it may never happen, and I hope it doesn't happen, you can never be over-prepared. And again, I always say to people, just, worst case, I leave it to my kids in my will, and they have a little bit of physical gold, and they can just hold it for their kids. But if you have that safety, it lets you sleep better at night.
Be prepared, like the Boy Scouts say, always be prepared. I want to quickly touch on the miners, though, because they have been on a tear. The VanEck gold miners ETF GDX up, I believe, over 104% year to date last time I checked. For a long time, we were lamenting how the miners were not reflecting the rise in gold price, but that seems like that is no longer the case. Are the miners accurately valued, overvalued, still room to run? What do you see there?
Yeah, so the GDX chart here is very short-term extended. Now, listen, we could argue whether or not after a pullback they should go a little bit higher, but I'll just be fair with you. Like, so I'm a big player on the shorter term, and I'm short the GDX right now. But again, keep in mind, no one freak out about it. It's like, I'm looking for a 10% retrace or an 8% retrace, and then I'll start buying it up again. But when you have a chart that goes this vertically to the upside, it is due for a pullback. Essentially, too many people are rushing in thinking it's easy money, and you're due for some sort of correction. The level I am looking for basically to start buying this would be a retrace. And you can see how the beauty of trend lines. I just love trend line analysis. You take your high going back to October 2024 to this pivot high in April of 2025. It connects beautifully to this little up and consolidation. This is where we broke out. So in technical analysis, I'm basically shorting with a pullback expectation to about 61. And then I start buying again for the next kind of trampoline lift off to the upside. And so again, near term, just like gold has a topping tail. I think it pulls back. I think that brings the miners in. Miners always correct, and they go up and down more than gold generally. And so you'd expect a bigger pullback in the miners. And again, I'd be a buyer around 61-ish or so on the GDX.
Right, and I will point out that you are a swing trader in and out of positions. That's a very important way that you manage your investments and your portfolios.
Funny.
But
it's so funny because, one thing I'll mention to people is that because I'm immersed in the market every day, trading, day trading, swing trading, left and right, what I have to do is, if I'm ever going to hold something long term, I need the physical. And so I've been such a big fan of gold since 2023, even 2022 and 2021, is that I buy the physical, and then it's such a pain in the butt to sell that I just actually will hold it. And I'll hold it, and I've been holding it, and that's great. But if I'm in like the GDX and I see it run up this much, how do you not take a little off the table when you can see in the charts there's an 80% chance that it pulls back, right? And so I'm a probability trader.
Right, makes sense. Well, how much silver have you got? Because we've had a pretty great run in silver. Let's take a look at what the charts are telling you there.
Yeah, charts are looking good on silver. I continue to like silver here. You can see you had this beautiful wedge pattern right here. And again, this wedge pattern, look at this trend line, how every time going back to 2023, every time it hit, it pulled back, pulled back, pulled back, pulled back, and then pulled back recently in 2025 twice. And then what it does is it gaps above. It's like, okay, I can't walk through this river because the rushing river will take me away. So let me hop over. Let me take the bridge over. And all of a sudden it breaks out, consolidates. This is a bull flag, and it's beginning to move higher. So this is a breakout on silver. And silver we know has lagged gold. I do think it's playing in the process of playing catch up. Basically, I'm expecting it to have a small stop at $44 per ounce, but really likely headed to about 48 to 50, which would then, if we go to the bigger time frame, 48 to 50, where does that take us? Back to this high here, 1980 and the 2011 highs. Essentially, that would be called a triple top, and that would be expected to be resistance.
So what level would that be at there?
Yeah, so you basically look to sell it to $48 to $50. So if silver gets to 48 to 50, I would expect it to pull back. Now, it could eventually break out, and that's what I would start to watch. And let me just do a quick teaching on this. So if you have silver, right, and silver, let's say, rips up to 48 to 50. Let me get my drawing tool out here. So let's say we rally up here. You then watch, as a technician, you watch to see what it does off of this level. What you want it to do is basically go sideways to lower, which creates a bull flag. It's essentially digesting. Think of a marathon runner who just ran a marathon. They're exhausted. You can't be like, go run another marathon. They're going to be like, no way. I need to refuel. I need to sleep. I need to rest. I need to eat. This is what this is. It's consolidating. It's refueling. And then you get your big move up. What you don't want to see is you don't want to see a sharp reversal. A sharp reversal would be bearish. So as a technician, if let's say we get to $48 to $50 an ounce on silver, I will then begin watching what price does around that level, and that will give me insight into the next likely move.
I want to throw out some macro factors and some macro developments regarding silver to see what kind of insight they gave you along with the technical side. And the U.S. has just released its updated critical minerals list. Big headline that silver made the cut for the very first time, and critical minerals are defined as non-fuel minerals that are vital to America's economy and security, and also face risks of a supply disruption. So putting silver on that list, that's quite a turning point. Washington signaling that it sees it as strategic and, part of a broader push to reduce import dependence, lock in secure supplies, stay competitive in the global race, so forth and so on. We also had a very interesting sign out of Saudi Arabia, where the Saudi central bank recently bought about $40 million in SLV and silver miners. So SEC filings show that it could have been the central bank. It could also be the Saudi sovereign wealth fund making that play. But, on the macro side, silver has both a monetary and an industrial demand component. What do you see driving the next leg here? How much are these macro factors coming in to your analysis? And are there any other signs that you're looking at?
Yeah, so I think what we're going to see here is that, silver is going to be seen as obviously the macro, driver of combustion engines, which are now becoming more and more popular again after the EV kind of had its phase. And I still think EVs are in that direction, and they will continue to grow, but not nearly as much as people thought. And so I think you have that aspect to it. But I also think that you're looking at, there's these sovereign funds in these countries that are saying, okay, gold has had this massive run, and just like the dollar, we don't want to just be in one metal. Like, what if something happens and there's a massive find of gold? Let's diversify. And I think, again, what's so interesting here is that these countries are learning from their mistake with accepting the dollar as the major reserve currency, where it gives the U.S. way too much power. They're not comfortable with that. And now they're saying, okay, listen, gold is great, but now let's also have a little of X, Y, and Z metals in our portfolio. And I think that's a great thing. I mean, it's the equivalent of having Bitcoin, but having some Ethereum in your portfolio. Same sort of thing, or Apple and Microsoft and Google, right? We just don't go all in on one thing. And they learned from what they've done with the dollar and the power that the U.S. wielded.
So it's interesting. You're saying that you think central banks are starting to see silver as a monetary metal as well, as an industrial metal, and acting accordingly. That's a very similar viewpoint that David Bateman has. He's the billionaire tech founder of Entrata. He recently invested close to $1 billion in silver, particularly in precious metals. In fact, he posted on X that he bought about 1.5% of the annual global silver supply. And his reasoning, the global monetary system is about to collapse, the Great Reset or Basel Endgame, the biggest credit bubble in history will soon pop. There's no way the U.S. can refinance its debt in the next 4 years without an obscene amount of printing. Trump tariffs are hastening the collapse, and it's by design. Gold and silver are the only meaningful life raft. Physical possession is everything. The whole world right now is a sophisticated game of musical chairs. The chairs are precious metals. Crypto is a psyop. Those who purchase will have no chair when the music stops. Those who purchase will have no chair when the music stops. I guess those who do not purchase will have no chair when the music stops. Real estate, crypto, stocks, and bonds will all lose significantly compared to precious metals. The banking system has been meticulously designed to seize your assets, to buoy a collapsing banking sector, see the great taking. You have zero counterparty risk with precious metals. He goes on to say your grandkids will thank you someday. What do you have to say about his analysis, his thoughts there?
I would say I couldn't have written it better myself. I've gone on record for the last few years as saying that we are slowly, it's like a train wreck, a very slow train wreck of countries overspending, running up debt, and eventually the fiat system will collapse. I actually think that the Federal Reserve will be the scapegoat when all this goes through, and I think the Fed will likely be disbanded, and there'll be some new form of a Federal Reserve that's put in place. But the basis of it is that those that have physical metals, that is where the value will be held. And I think that's the key. And it's almost like a societal reset, right? I mean, you see everything going on in the world today, and it's just getting worse and worse and worse, whether it's social media or all these other avenues. And it's going to reach a boiling point. And the U.S., along with all these other countries, they've lived off of debt, and it's unsustainable. And there will be a collapse, and it will be a financial reset. I do think what comes from the ashes of that will be amazingly good, but it's going to be the hardest time, like we talked about earlier, since the Great Depression. It will be the hardest time, hopefully not worse.
You know, it's a very similar idea as what Larry Lepard put forward when he was on the show in his book, The Big Print. Says that the fourth turning is upon us. We're in the crisis phase of that generational reset, and that this time it revolves around money. Timing is everything. Can I push you to give a general time forecast on that one? I'll give you leeway. I'll give you leeway on that one because a lot of factors can change.
And I think this is important is that things that we see, people that view the future and look at the tea leaves or the breadcrumbs, we see it coming a lot earlier than it actually does because there's always a lever, it seems, that can be pulled by either the government or the Fed that kind of just prolongs it. I always liken it to a patient that is basically being kept alive by artificial drugs, right? So the doctor's just pumping the patient full of drugs to keep them alive. That's where we are right now. Now, at some point, you pump enough drugs into the patient has an OD and dies, and that's what I'm fearful of. But in terms of timing, the only thing I can point to is that 100-year cycle that is later this decade, obviously, coming in. And I think, again, there'll be enough levers to probably keep us from getting to that point before then. But I would say in the 2030s, the early 2030s, you got to be prepared. And prepared, by the way, goes beyond just some physical metal. Like I personally am, and listen, I don't want to sound like a crazy here, but like I'm in the process of building a house. It's a structure that is concrete, ballistic windows, solar on the roof with battery backup off the grid, like all of these things. And listen, I pray that I'm doing this and I'll just be like, oh, well, it was a fun event. But I would much rather be prepared if financial collapse does occur, because financial collapse, the way society is, it's not just going to be a simple like, oh crap, we collapsed. It is going to be major unrest, and you got to be prepared.
Rather be prepared, rather have, not need, than need and not have. I think that's generally sound advice. And as we've discussed, I know that there's some space for me in that safe haven that you're building there.
Absolutely.
So if need be, I'll seek shelter with you and your family. But hopefully you're wrong. But it does seem as though that is, an idea that is catching more and more traction in the mainstream and in the narrative at large. You did say something that you agreed with Bateman on everything. I suspect you missed the part where he said that cryptos are a psyop. I don't know that if you agree with him on that one, because I do know that you do have quite a strong bullish case on Bitcoin as well, and you've had some amazingly correct calls on Bitcoin through the years. So give me your Bitcoin outlook.
Yeah, so I am, and I've been called a perma bear on Bitcoin, but in all fairness, I am a mid to long-term bull on it. But I will say, if society really collapses and the grid goes down, yes, you could have it off, on a wallet that you carry around with you and such. But in general, I think that people are looking for an alternative to the U.S. dollar for safe haven holding of assets, and Bitcoin offers that. And so I do think, I can't tell you where it's going to be in 10, 15 years from now, but after a correction that I do think we are close to, and I will go on record and say I do think Bitcoin's going back to at least $75,000 a coin, probably by early 2026. But I do think at some point it goes a lot higher, and then we'll just have to see how the whole world-ending type scenario comes into play with it. But I do think that, again, society is craving an alternative to fiat currencies, and Bitcoin is that answer for now, along with gold, and people are willing to accept it. And as long as people accept it and can access it freely, then that still has a place in the future.
That's a pretty big statement. You see Bitcoin pulling back to $75,000 by 2026?
Yeah, and probably I would say within the first quarter of 2026, even cutting myself even lower here.
You wouldn't see a massive rally on the rate cuts more liquidity, or then as the market starts to sell off, I guess the correlation has always been there. Is that what you would see happening with Bitcoin?
That's more what I see is the correlation, right? So if we look at 2021, when we had the bear market in the stock market, we obviously saw Bitcoin falling all the way below 20,000. I don't think it's going to fall as much because you have a much more diversified group of holders, including big players like BlackRock. But I do think, you're talking if the stock market corrects 20 or 30%, Bitcoin likely corrects 30 to 50% from these levels.
And look, Gareth, to your earlier point, being prepared, seeing what could come ahead, the idea that the fiat era is perhaps winding down is again certainly gaining a lot of traction. We've had lots of conversations on it on this channel. Bitcoin and gold seen as alternatives, neutral reserve assets. So a big topic that we cover here on the show at large. So interesting that the technical charts as well as the macro charts macro thesis seem to kind of coalesce on that one. As we wrap up here, Gareth, being a chart guy, what is the single chart that you would put in front of every investor today if they could only look at one chart?
All right, so if you can only look at one chart, you have to watch the S&P 500 here, folks, or the Dow. In fact, I'll just bring this up one last time here because I think it's so important. So the S&P chart, folks, if you're looking for a break, and this gives you the beauty of technical analysis is there's no gray area. It's either it breaks a trend line or it doesn't. This trend line that goes back to earlier this year has held this market in check. If we break 6,500 on the S&P, I think you go below 6,000, which means, again, about a 10% or more quick correction, probably over the course of 2 to 4 weeks. And ultimately, if we look at the Dow is now at the tightest point of its wedge. And this makes me think next week. And again, I love pigeonholing myself so people can tell me when I'm wrong. But ultimately, I don't mind it. I don't mind going out on limbs here. And it looks to me like if the Dow breaks next week and something is going to break here, this could be with the Fed next week, then you're going to start getting this bigger correction starting next week, which would match past cycles that when the Fed cuts, the markets start topping out and starting to fall.
Look, Gareth, this is what I love about you. You do put yourself out there. You do give very specific forecasts and outlooks, and people love you when you're right, which is the majority of the time, and they give you one heck of a hard time when you're wrong.
And they, frankly, when I'm right, sometimes they hate me too because sometimes it doesn't go in their direction. But I get it.
But I appreciate the fact that you're always very, very specific and coming from very informed positions there. So final thoughts, what is your point of highest conviction right now? What is your most contrarian call? All of the above.
Yeah, so contrarian call. Listen, retail is very, very bullish. Robinhood, Palantir, these stocks, even Oracle and some of these other ones. I would say Nvidia's on the verge of having a bigger pullback. Probably what it saw during the Liberation Day sell-off was about a 40% or so fall. I think you're probably going to get another one of those in the next 6 months, along with the rest of the sector. Bullishness has gotten way too out of control. My money is being put in defensive names. I love dividend. There's some high paying, like UPS pays like a 7%, I think, or maybe even higher dividend at this point. So if you have to be invested, there are places where you can get stocks that are at 52-week lows that at least pay out a dividend, which I look at a dividend like protection, right? If the stock falls, if it pays a 7% dividend and in a year it falls 7%, you basically broke even. Versus some of these stocks in the stratosphere are beyond belief. Now, I love the Chinese stocks a month or two ago. They have rallied 50%. I think those now have to pull back. But keep an eye on Brazil, the EWZ. That's one I think as well. I think money is going to start hunting for outside the U.S. investments and start rotating out as the U.S. economy weakens.
All right, Gareth, people that want to learn more about you, get more information so they can love you and hate you when you're correct, where can they find you?
VerifiedInvesting.com. It's a website that I created that's all about the charts. We like to say no BS, just charts, meaning that the charts dictate our decisions. And if we can eliminate emotion, which again, social media is going to get you to be the most emotional you can be. Mainstream media has narratives. Michelle Makori right here gives it to you straight. It's amazing. But ultimately, the charts also give it to us straight. They don't have a bias. It is what it is on the chart. And if we can look at the charts and understand, we can make informed decisions on charts and the next move and make money from that.
All right, verifiedinvesting.com. Gareth, thank you so much. Look forward to having you back on. Really appreciate it. Gareth Soloway.
Thank you.
And thank you all for watching. Remember to follow us on social media. Make sure to hit the subscribe button. And again, please leave us your comments and feedback. We do love to hear from you. So as I like to say, feel free to praise, whine, or just opine. For me, Michelle Makori, and the rest of the team, we'll see you next time. Stay sovereign.
This is The Real Story with Michelle Makori.